We're still not yet at the point that we have seen a pullback in things like AI spending and investment spending on data centers, which has become a critical component of the U.S. economy and our global growth expectations. There's indications, of course, that that will continue. On the flip side of that, there's growing market indications that there may be some challenges there. In particular, I would highlight that you're starting to see credit spreads widen. Banks have begun reevaluating their position after many of the losses that have been generated in areas like private credit or smaller deals that were done directly in the ABS space where there was improper collateral, et cetera. And so all of that is basically leading to what you would expect, which is a slowdown with deteriorating credit conditions. And the one thing that everybody keeps pointing to is, well, credit condition or financial conditions must be loose because the stock market is hitting new all-time highs. As we discussed, I guess, over a year ago, I tend to disassociate that from the actual economic performance for the very simple reason that I believe most of the behavior that we see in the stock market is now largely a function of what I call the passive bid, as compared to any sort of thoughtful, forward-looking application of, the principles of finance or valuation.
Hey everyone, and welcome to another episode of the WTFinance podcast. On this podcast, I have the pleasure of welcoming back Mike Green. So Mike is the portfolio manager and chief strategist at Simplify. So Mike, thanks so much for coming back on the podcast.
It's a pleasure to be back, Anthony. Thank you for having me.
Yeah, no problem. Yeah, it's been a couple of years, so glad that we could get you back on and hear your perspective on the crazy world that we're currently living in at the moment.
It's been a couple of years. Is it really that long? Wow.
I think so, yeah.
Implies when you're having fun, I guess. Okay.
So, I'd like to start really broad, really top down. What is your current sort of outlook on the economy and what we've been seeing, I guess, the last 6 to 12 months?
Well, I think the challenge right now is disentangling the elements of what's actually happening in the economy versus the current levels of government shutdown. We are clearly seeing things like a deceleration in payroll tax collections in both the private sector and in the public sector. How much of that is tied directly to the government shutdown is very difficult to disentangle. Prior to the government shutdown, we were seeing pretty strong evidence of an economy that was slowing. We just got NAP inference, the ISM today, that suggests that we've seen continued slowing and weakness in the manufacturing sector. The one positive is there was a little bit of an uptick in new orders, which suggests that some of the destocking and inventory may be approaching a limit. But the flip side of that is when you cut off food stamp benefits and you cut off support for large segments of our economy, you run the risk of effectively creating phase changes in people's behaviors. If you miss your rental payments for 2 months in a row, even if you were a government employee, the odds of an eviction proceeding beginning against you, same thing for your mortgage, et cetera. These are all areas that have now become distinctly uncertain because of the actions of the U.S. government. That is compounding the concerns that we already had around deteriorating household credit, particularly at the lower end, and a general slowing of the economy after the extraordinary stimulus that was experienced in 22, 23, and to a lesser extent 24. As we start to sunset those characteristics, we're beginning to see that the economy is nowhere near as strong as people had forecast. We're still not yet at the point that we have seen a pullback in things like AI spending and investment spending on data centers, which has become a critical component of the U.S. economy and our global growth expectations. There's indications, of course, that that will continue. On the flip side of that, there's growing market indications that there may be some challenges there. In particular, I would highlight that you're starting to see credit spreads widen. Banks have begun reevaluating their position after many of the losses that have been generated in areas like private credit or smaller deals that were done directly in the ABS space where there was improper collateral, et cetera. And so all of that is basically leading to what you would expect, which is a slowdown with deteriorating credit conditions. And the one thing that everybody keeps pointing to is, well, credit condition or financial conditions must be loose because the stock market is hitting new all-time highs. As we discussed, I guess, over a year ago, I tend to disassociate that from the actual economic performance for the very simple reason that I believe most of the behavior that we see in the stock market is now largely a function of what I call the passive bid, as compared to any sort of thoughtful, forward-looking application of, the principles of finance or valuation.
Okay, yeah, a lot to unpack there. So you're seeing the government shutdown actually having. Do you think this will be a sort of catalyst for a further deterioration of what we're currently seeing, or you think it's something that will resolve?
Well, you can work in both directions, right? It really depends on how it resolves itself. The most important thing that we're running the risk of now is the people that were already struggling to pay their bills, pay their dramatically increased homeowners insurance, pay for increased auto insurance, increased healthcare expenses, etc. This can very much be the straw that breaks the camel's back if it pushes you into a point at which your credit lines, credit card ability to finance your lifestyle and your credit card gets impaired because you miss a payment. Those things stay with you for a very, very long time. And so this is, one of the characteristics of the phase change associated with credit that doesn't really exist in other areas. It's one of the reasons why people follow credit very closely as they think about the cycle or the stage of the cycle that we're in. Banks tightening up credit conditions, the risk of default and delinquency, which changes your credit rating and therefore permanently changes your ability to access credit and spend beyond your current income or even close to your current income once you enter into a debt resolution that requires you to start paying payments down while not drawing additional credit. Those are very important changes in a macroeconomic framework that I think people tend to underappreciate. They're non-linear in their construction.
Yeah, it's a great point. Are we seeing sort of credit spreads, increasing as well? Because I think that's something that they're being actually quite narrow. Was that another issue with this passive bid? I'm guessing it's sort of moving into credit as well.
Well, it definitely plays a role in credit. In particular, the allocation to total bond indices is influencing the investment grade space. The much more important thing that's happened in particular in high yield is the relative lack of issuance. So I run a high yield fund, for example. A typical high yield fund will generate about 25% of its cash AUM in returned principal every year. That's a combination of bonds that are maturing and receiving cash for those. And the coupon, which is currently about 7%, is going to be tacked on top of that. So you end up with somewhere in the neighborhood of 20 to 27% of the cash being returned every year. When there's not a lot of new high yield issuance, that actually creates competition for the secondary securities that are trading, which is just another way of saying if credit spreads tighten. This has been an extraordinary period where the credit issuance has not come anywhere close to the credit issuance that existed in 2020 and 2021. As we move to kind of the traditional maturity profile of high yield, that 5 years out from that point, you're seeing that there's a mixture of a shortage of high quality secondary securities in the high yield space. That means either you're stretching for yield by buying lower quality stuff, further compressing credit spreads, or it means that you're chasing after the existing high quality stuff, i.e. tightening credit spreads. The companies are much more worried about the level of interest rates than they are about spreads at this point. But the simple reality is that the secondary market liquidity in high yield is relatively strong because there is so little product that has come to market.
Yeah, okay. That is a great point, as you're saying. And I guess the governments have an impact on that as well, because they're sort of bringing everything on the short term of the curve as well, as you're saying. So then,
well, there's some of that, right? So theoretically, I could bid for duration in rates, and I have done components of that because I thought that the credit spreads were not attractive relative to rates. But within any sort of modern fund incarnation, there's very much an element of, maintaining the mandate that you were actually hired for. So I can't be a credit fund that suddenly decides that I'm going to dash off and do, speculative equities. That means I basically have to reinvest into areas that look very much like high yield, and that creates that tightness that we're identifying.
Okay, great point. And we're seeing the Fed, they're sort of they're cutting interest rates. It seems like they're seeing this sort of economic conservative. So they're seeing this employment data coming through as well. So they see there's risk on the horizon. Do you think they've sort of left it too late? Does it even matter what they're doing at the current situation? How do you see it?
Well, the thing I love about the Fed, right, is Jerome Powell has told us that he is data dependent, and we know that that Fed actions happen with that Fed actions flow through to the economy with a lag. Typically, it's 6 to 9 months from the point that you change interest rates to any meaningful flow through in economic activity. If you are data dependent, by definition, you're looking at data that is in the rearview mirror. Now are trying to engage in policy choices that won't impact for 6 to 9 months. It just means the Fed is always going to be late under this formulation. It is a direct byproduct of what I think Jerome Powell is one of the worst Fed chairs we've ever had. And one of the reasons for that, candidly, is that he doesn't actually have a working model of how the Fed impacts the economy. That means he's forced to respond, effectively driving through the rearview mirror, as compared to thoughtfully applying any formulaic principles towards the economy that could forestall crisis with foresight. The problem with that, of course, is if you act with foresight, either to tighten financial conditions or to loosen financial conditions, run the risk of being wrong. And that's something that nobody wants to hear about today, right? It's presumed that the Fed is wrong. And so, if you happen to own stocks and stocks are going up, then you're pretty happy with the Fed. If they're not, then you're pretty unhappy with the Fed.
Jerome Powell is sort of, is he definitely going to be out of a job in 6 months? It seems like. Are you concerned that, it does seem like there's going to be potentially a trailblazer, a new Fed chair that comes in that's definitely seems like it's going to be extremely dovish? Are you concerned about the impact that would have on, I guess, the economy, inflation, yields, other aspects?
Yeah, I mean, I think, as you know, I have a somewhat mixed view of the Fed's role in the economy. I don't think the direct transmission mechanism that most people think about is really the right one. The most important role that the Fed plays at this point is in collateral management. If they cut interest rates, bond prices will rise. Those rising bond prices, all else equal, mean that people are underweight in other areas of their portfolios. And so lower interest rates translates to higher bond prices. If I run a 50-50 bond equity portfolio and bond prices go up, I now need to sell bonds, buy equities. And so that can translate to a market behavior. The actual transmission into the actual economy, either creating inflation or allowing it to persist, I actually am very skeptical of that. I think the most important role in terms of the actual real economy is the fiscal transfer that's created by higher interest rates. We've started to see interest income to the household and corporate sector begin to deteriorate.
So yeah, as you're saying, it doesn't really matter who comes in. It's all about, as long as that collateral's there, as long as, I guess, there's liquidity in the in markets and the economy, which is a function they provide as well. Things should be fine.
Yeah, I definitely think that's true. Although remember that every time a new Fed chair comes in, there is a component of lack of continuity. People need to get used to the cadence of the new Fed chair. They need to, the Fed chair needs to learn how to parse his statements. Jerome Powell is now, I believe, 8 years into this process. He has learned, a tremendous amount in terms of how he communicates with the street, the language choice that he has. This is all very much kabuki theater in a lot of ways. But when you introduce a new Fed chair, there will definitely be uncertainty around how they behave. Whether that dates back to Alan Greenspan in his first month as Fed chair, there was 1987, to Jerome Powell himself when he became Fed chair. You had fourth quarter of 2018, which was obviously concerning for markets. The transition to a new Fed chair is largely about that lack of confidence and uncertainty. Once you introduce that, you have to recognize that has increased the cost of transacting in the market. And so, there will almost certainly be an adjustment period during which time, various people will say this is the new worst Fed chair of all time. If it's an overtly political appointment, people will be looking to hate it. If it is a traditional choice, somebody like Waller, we'll hear all sorts of complaints that he's never actually traded, that he doesn't really know businesses, Fed researcher for life, et cetera. But I don't think it actually matters all that much.
Okay, really interesting. And do you think that's what's happened with Trump as well? I guess, you could say he has a very different way of communicating, or is he just sort of quite a bit of an enigma when it comes to the president and the impact he has on markets as well?
I don't know how you can really define anyone who likes taco salads from Taco Bell as an enigma, right? They're a pretty simple individual. I do think that there is an element of Trump where people very much, at least initially, want to find reasons to be outraged. And whether that's the Europeans in February, March, as they decide, we'll show the Americans by selling all their stocks and bonds, or whether that is, China negotiations or Congress, which is currently going through a anyone but Trump type moment. These are areas that create outrage. But as we've seen, they don't really persist because I just don't think they're actually that meaningful and impactful until the employment situation in the United States changes meaningfully, which, could affect the flow of assets and retirement funds into the markets. But as much as I want to care, I just don't care that much. Right. I think at the end of the day, we are largely trying to construct narratives to explain what's happening in markets, not the reverse. I apologize for all the people in the background, but I'm in an airport club in Chicago.
Yeah, that's okay. No problem at all. So, tariffs has obviously been a big aspect of what is brought in, and, I guess a revenue raising aspect of his administration, which has been quite successful so far. So you see that as being something that could potentially, have a positive impact on deficit reduction and potentially, it is really a tax, just in a covert way, which people will realize at a later date.
Well, I would emphasize it's actually not much of a covert tax at all, right? People have been very transparent to the tax. The question is, who is it borne by? At this point, we are aware that it's borne, somewhere in the neighborhood of 40%, 60% by the household, about 20% by the corporation, and about 20% by the exporter, China. How that plays through in the long term, we're not even certain that these are going to survive the Supreme Court challenge. But if they do survive, then an entirely different question emerges, which is what tariffs are really largely about is creating an incentive for people to purchase goods and services in the United States, recognizing that in particular those who receive benefits from the United States, whether that's retirement income, et cetera, should actually pay a penalty if they ship those funds abroad. That's what tariffs are largely designed to do, is to redirect a component of that surplus that we express as a trade deficit in the form of money that is spent in the United States and then becomes income for the younger generation of workers. One of the most interesting part of the, what I define as the Trump derangements, to be very, very clear, I have lots of complaints about Trump. I'm certainly not a Trumpy or anything else. I did vote for him because I do think that the alternative would have been worse. But the simple reality is that people missed this fiscal consolidation. We got, I think the technical term is they got their panties in a bind, talking about the U.S. losing control at the long end, et cetera. I think that's largely been put to bed in the past couple of months. At the same time, the simple reality is if Trump decides to use this tariff stimulus or tariff tax as a stimulus, a tariff distribution back into the lower income individuals in the United States, that may prove to be a very popular component on a short-term basis, but that actually would be a really critical catalyst, then recharge the demand function and starts to create the conditions under which inflation could actually take meaningful hold. In the United States, we have an increasing number of corporations that have pricing power. We're seeing the increase in prices in grocery stores. As food is increasingly unavailable through things like food banks and supplemental assistance, that's pushing additional demand through the traditional channels. That's creating some additional food inflation, even though this is an area that should be theoretically unaffected. There's long lag components to it that are playing through that remain largely a byproduct of the COVID shutdown and the post-22 Russian invasion of Ukraine. But those costs are going higher, and it is putting stress on consumers. And an increase in subsidies coming through in the form of a tariff distribution check would provide additional funds to high consumption probability individuals that could create yet another inflationary pulse. We're just not going to know until we see how Trump behaves.
Yeah, and are you worried about the impact that it will have on for investment as well? So there's actually could be a pull out of sort of capital from Russia.
I'm less worried about the pullout of capital, although I think that could start to happen as we begin to see interest rates cut, because that's reducing the income that people are earning off of their assets. We're already starting to see that income begin to fall. We've not yet seen it translate into the need to sell equities. But this is one of the underappreciated components. If you were a retiree who's retired in the last years or so, you saved with the expectation that you're going to earn very little on your cash assets. Those cash assets are now yielding 4+%. That's creating a surplus that is translated into increased capacity to spend in the older generations, the wealthier individuals and households. As we cut interest rates, that's likely to retreat far earlier than we would see the impact on the corporate financing markets, for example.
Good, interesting to hear. And then is this also just a sort of aspect of the geopolitical play? Trump's mechanism, as you said, it's almost like it is a prioritization of America first. It's a shift away from, I guess you could say, subsidizing other parts of the world and letting China, basically, have a large portion of manufacturing.
Yeah, I definitely think that's the case. And I would just emphasize that many of the geopolitical actions that you see, at least on their face, appear very small and petty, right? Should we blow up speedboats from Venezuela as they're attempting to ship drugs to the United States? The simple reality is that's not what this is about, right? What we are doing is reasserting control over South America. Venezuela is the gateway into the Panama Canal for a country that is coming in from the Pacific Ocean, which is far harder to control. You exit the Panama Canal into the Caribbean. Venezuela is right there. All this is really doing is saying, hey, look, China, we can take target practice at little speedboats. What do you think we can actually do with tankers? Argentina has a very similar component to it, right? At the end of the day, Argentina controls the end of the world, Tierra del Fuego, which is the access point to get around South America, the southern tip. The United States is now forming a very strong partnership with Argentina that allows us to put in place military assets to prevent transiting the southern pole to take the southern route. We are talking about taking over Greenland, which would take across the Northwest Passage. These are all areas that are effectively us extending the trip to the barrier of the first island and second island chains in the Pacific, recognizing that it'll be very challenging to control those if China makes a concerted effort, but basically doing the exact same thing from distance, which is the prerogative and capability of the United States. It's a remarkable asset, our military positioning and our geographic positioning in the globe.
Okay, so return to the Monroe Doctrine. And do you see that also, that the US will then pull away from, obviously the Middle East has been a major sphere, Europe, Asia. So it's the fact that they realize that they can't continue in all these spheres. Is that what you're seeing?
Well, I think what they're doing is they are intentionally retreating to defensible positions, right? It's actually very hard to hold Taiwan if China makes a concerted effort. I'm going to flip that and also say it'll be very, very hard for China to take Taiwan in the violent show of force and maintain that control with a mountainous country and island that lends itself actually to guerrilla warfare. It would be very challenging for China to take and control that. Ultimately, if they are going to take control of Taiwan, it's going to be a function of the Taiwanese people deciding that it's not worth defending themselves. The Ukrainians, might have had a similar vote if they were given the opportunity. We'll see how that plays out. That's a very, very hard one to handicap at this point. The remaining portions of it is just saying, look, it's a lot easier to prevent ships from transiting around Tierra del Fuego than it is to actually try to control Taiwan. If you don't necessarily want to sacrifice American lives in order to do so, it becomes much easier to let China do what it is, in my opinion, continually doing, which is shooting itself in the foot on global political relationships. The United States has basically said to many of our allies, look, you guys have to actually start taking China seriously. Most allies kind of laughed about that and said, in some version of the salty Bitcoiner meaning, well, you're just upset because you lost the global manufacturing lead to China. And we simply point out, all those imports that are now no longer coming to the United States that are flooding into your countries and negatively affecting your manufacturing sector, you should probably figure those out. And the rest of the world is waking up to China's unfair trading practices and is actually, ironically, more inclined to respond to the United States, in part because they have not had the huge trade deficit that the U.S. has been able to maintain and become accustomed to under multiple administrations.
Okay, and what are the Chinese? You mentioned the Chinese sort of missteps in, I guess, global relations. What have you seen in that regard?
Well, I think the most important one that I would just highlight is that there's an awful lot of talk about the BRICS and China doing a gold-backed yuan, et cetera. These are dead on arrival. At the end of the day, all empires and all currency systems need a consumer at the center of them, somebody who is actually willing to buy the production from everybody else. And China is really with the BRICS. That just doesn't exist. There is no consumption center in that process. China in the post-COVID era has basically not changed its imports at all and has dramatically expanded its exports. That's left it in trade surplus virtually every country around the world, with a notable exception of commodity exporters. And those commodity exporters in general are not rich enough or large enough to afford anything close to the production surplus China has to ship abroad. So it just becomes a non-entity. Right? It's an unbalanced trading regime without a consumption center like the United States sitting at the center of this. You've heard me use the expression, we say all roads lead to Rome. Well, that's kind of silly, right? Roads go in both directions. So why don't we say all roads lead from Rome? Well, it's because everybody transited to sell their goods and services in the center of the empire, Rome. It was the consumption center. The United States played that role on a global stage, as we have refused to play that role by introducing trade barriers that, at least in principle, are designed to re-advantage the working members of the United States. That ultimately, puts the pressure on everybody else, and the world is closing itself off to China.
Then that's one thing. So you're not seeing an end to the U.S. empire. You're seeing, I think you mentioned it before, it's a shift in how it's run, or a shift in, I guess, its influence on the world. Yeah.
Yeah, I think that's right. And, I've made this emphasis repeatedly. I think people who are talking about the end of the empire, the end of the Roman Empire equivalent, missing a really important caveat, which is, the Roman Empire began after the Roman Republic fell. If there's anything we're at risk of in the United States, it's our loss of republic, our ability to actually actively participate in our government in a formal articulation. The American public and our elected representatives have done a remarkably poor job of advancing the interests of the United States. One of the reasons the window was open for Donald Trump to basically be the first president who said something along the lines of, I actually care about those people you call deplorables. I don't believe them, but it's a much better message than you're deplorable.
How have you thought about how that would look like in the US, or is it too hard to sort of gauge what that would be, or are we sort of moving there at the moment?
Well, I think we're already moving in that direction, right? Our elections are becoming increasingly performative. We see fewer and fewer substantive changes on change of control. I think most people would actually struggle to name their congressperson. I think many people would struggle to name their governor. I think most people would have absolutely no idea who their federal judges in their district are. We've largely abdicated our responsibility as an electorate to thoughtfully select the leadership.
So yeah, we just think about the president rather than all the other,
We think about the president. This was, the innovation of Octavian as he became Augustus Caesar was not to call himself emperor, but to call himself the first citizen, right? And performative voting continued. You continued to have the Senate. You continued to have various legislative bodies within Rome that were ostensibly elected, but at the end of the day, veto power existed with a single individual who ultimately just began to make fun of the other bodies, which is what we read about in the history books with, individuals like, I'm totally blanking on his name, declaring that, Caligula, declaring that, his horse would be a better senator than the vast majority of senators.
Okay, and is this something that you think is like, because I guess institutions have always been political in some way or another, but it just seems like it was maybe done in a less obvious way, in a more subversive way. It was, the Federal Reserve, you could say, was very political at certain points in history. So do you think it's just more obvious now, or do you think it's just that maybe the general public don't care, as you said, they just don't care that it is more obvious, and they think it needs to change?
Yeah, I think at the end of the day, most people are far less informed. Our civic education in the United States is, abysmal. And you're just at the stage where I think the vast majority of people, as long as you told them that performative elections were going to continue, would defend the institution of elections, even as they themselves don't really participate or care at a level that would meaningfully impact their lives.
Okay, yeah, really interesting. But it still seems like there's room for all these powers to live in this world as long as they don't push the US too far.
Yeah, I think. Look, to pretend that the United States is suddenly going to return to its position as the city upon a hill, in which our moral leadership is the guiding light for the rest of the world. I think there is some truth to that historically. I would hope that we could ultimately reclaim that, but my expectations for it are quite. A generation raised on TikTok is unlikely to lead the world in the field of moral battle.
Yeah, I guess it's a challenge if you need the hard times to then get that situation tension.
This is the Palladian cycles, right? We currently have lived through a period of tremendous excess, and candidly, if our primary objections are you misused my pronoun and therefore committed violence against me, man, these people have got to meet a battle axe. That's violence.
Yeah, no, that makes a lot of sense, and I guess in the aspect of this is we've seen it with the government actually buying strategic I guess buying equity in strategic assets or strategic companies where they think that they don't have the US and won't be able to do this without the investment of the government. So I guess this is already, government moving into business.
Yeah, I mean, I think you got to be a little bit careful with that. Again, I think that it's very difficult to decide what is opportunistic within the Trump administration and what is thoughtful. There is very clear evidence of some thoughtful policies. There's very little evidence of thoughtful implementation of those policies. I've written extensively on things like the increase in fees associated with the H-1B visa programs. These can actually be really good things, right? Even Trump's introduction of golden passport, the sale of U.S. citizenship, that actually could be interpreted as a very positive thing. It's ultimately helping us to establish what is the value of access to the U.S. labor force, what is the value of U.S. citizenship. Those are market values that we could actually determine and spend a lot of time deciding whether our policies are adding to them or subtracting them, using the empirical feedback from those types of products and those types of services to help determine whether or not we're increasing or decreasing the single most important asset for most American citizens, which is their citizenship itself, the ability that that gives to earn and live within the United States in a somewhat unhassled manner. We just have shown no inclination to do so. It'd be foolish for me to project that that could happen. But ironically, we're seeing the first indications that at least we're being somewhat thoughtful about the things that we used to give away.
Yeah, and I guess we'll see if that happens in other Western countries as well, because it's probably
This is part of the issue, right? When you have representative governments, they exist to represent the interests of those who elected them, not people who live in other countries who are currently experiencing a really hard time. And I think it's tough that those individuals often struggle to obtain the opportunities for self-freedom and self-actualization that we take for granted in the West. But that shouldn't be borne on the back of our citizens in the way that it has been done for largely political purposes.
Yeah, I completely agree. So, Mike, thanks so much for your time today. We've sort of gone all over the globe, looked at many different, very complex topics, so I'm sure we could talk for hours about. But my last question is, what is one message you want people to take away from our conversation?
Well, I alluded to this before, right? I mean, one of my key frustrations as somebody who is trained in the tools of economics and finance is that we have not done a better job of actually explaining to people how the experiences that they're encountering in their day-to-day lives are influenced by the choices that we make on the policy front. Human capital is an extraordinary gift. Human society is an extraordinary gift. And because in many ways we've actually devalued that with many of our political and economic choices, we've created conditions under which people are now suddenly engaged in behaviors that appear suboptimal to most traditional economic analysis, but actually reflect the diminished circumstances in which they're existing. You know, the cost of moving from quintile 1 income as background to quintile 5 income, the highest level of income, is predicated on you obtaining access to a scarce and overpriced college education that if you fail in that attempt, you're going to be forced to carry unbelievable levels of student debt in a non-dischargeable fashion. That leads to people recognizing that that is no longer the path to success that ultimately makes the most sense. Instead, they retreat into small-scale gambling activities where effectively they're basically trying to buy lottery tickets in the hopes that they'll escape their individual deprivations. If we understood this better, we could actually start making the world a better place. But I just don't think we're quite ready for those conversations.
Yeah, great point. And fingers crossed we sort of move that direction. But Mike, thanks again. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
Easiest place to follow me is on Twitter at ProfPlum99. Confusing, my avatar is Dicini from The Princess Bride. You can also read my Substack at yesigiveafig.com. And if you're interested in simplified products, where again, I'm the chief strategist, portfolio manager, you can find us at www.simplify.us.
Perfect. I'll put this description below, but thanks again for your time.
Thanks again.
Hey, everyone. Thank you for listening. I really appreciate the support. If you got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right. Thanks again. Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe,
or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.